Hey, I want to show you just how easy it is to increase the value of an apartment building. We're going to show the math behind cap rate, NOI, and how a simple renovation can drastically increase the ability to sell a building at a higher price point. First off, we have to understand what a cap rate is. So a cap rate is if you are going to purchase an asset for cash, the unlevered return of that. So typically in the multifamily apartment game, it's between 4 to 7% cap rate. The lower the cap rate, the more desirable the property is and the less return it has. So the first thing that we need to understand is cap rate. So the cap rate, the formula to figure that is the NOI divided by the price of the asset. So let's say we have an NOI of a property of $100,000. That is income minus expenses, but before the debt equals our NOI. And we'll divide that by the price of the property. Let's say it's $1 million. Very original numbers here. That is going to be, let's see if I can do my math in my head, a 10% cap rate. Am I right? John, am I right?
No.
It's a 10% cap rate. I was right. I can do math in my head. So that is a 10% cap rate. This is also how you would value a portfolio. So let's say we have an apartment complex with $100,000 in NOI, and that kind of asset is trading at a 6% cap rate or a 6 cap. This is how we would find that, and this is 1.6 million. That is how we figure out the value of a property pretty quickly. All right, so what determines the cap rate of a property? Well, there's a few things that have a big impact on this. You got location, you have market size. So this would be, the location is a downtown property in a large city is gonna have a lower cap rate, let's say something in the 4% range for something like that, versus something out in a smaller city in a rural setting might have a 7% cap rate or something like that. So location, market size have a big impact on that. Also, the age and the quality of the asset. So something that's brand new, let's just say 5 years old, is going to be on that lower end, maybe towards the 4 or 5% cap rate, where something that is older, back in the 70s, 60s, might be 6, 7, 8% cap rate, depending on how it was maintained and everything like that. So we've got quality and age. Those are our other factors that can impact our cap rate. Two other things are gonna have an impact on cap rates. Interest rates are one of them, and that's kind of a macroeconomic trend that you're gonna see is cap rates will go up on properties as interest rates grow up. Another thing that can impact this is just the economy in general. So over the last, I can't spell either, that's something that we're learning. The economy here in general. So over the last few years, we have seen cap rates lower. That's because interest rates are down. There is a lot of capital in the marketplace looking for multifamily assets in particular. And then also depreciation laws. We have bonus depreciation, which is going on, which highly benefits investors. So that is something that is making multifamily investing more appealing than ever, lowering the cap rates of properties. So I teased in the intro about how I was going to show you how to make apartment buildings more valuable. Well, it's really simple. We have to improve our NOI. So NOI, again, is income minus expenses. It gives us our NOI. It's before any debt pay down. So $1 more of NOI can be really valuable. So apartment building is not just real estate. You have to think of it like a business. And this business has income coming in from rents and expenses going out from things like management, building maintenance, and all that stuff that goes along with holding with this. So the NOI impacts the value of the business, the value of the real estate. They go hand in hand. And if we look at it like this, by increasing our NOI and understanding cap rates, you can see just how quickly you can increase the value of your property. So let's say, let me run through a scenario that we do all the time. So I want to renovate a unit, and I want to know how much more valuable my property is going to be after renovating that unit. So if I increase my income by $1 or reduce my expenses by $1, and this property is valued at a 6% cap rate, then that $1 of improvement into my NOI, that is going to equal $16.67 of value increase for my property. Now that's huge. And let me show you how we play that out in a very real world example with a building. Let's say I believe if I renovate this unit, it's gonna bring in an extra $100 a month. So that is a $1,200 improvement in my NOI over the course of the year, right? So that $1,200, that's the increase in my NOI because I did this renovation. Now, and they'll say this is a 6% cap rate property. That's what we believe this would trade on the market for. So I can do that 1,200 divided by 0.06. That's gonna give me a $20,000 increase in value for my property. Now, for us, we're buying these properties at scale, large multifamily buildings where we can hire crews who just literally renovate units to achieve these returns. And there, we're only spending $6,000 to $8,000 per unit to get that increase in value on our property. It's a really simple way to understand, is this worthwhile doing? And so renovations, we're not only seeing the value of the property go up, but we're also increasing that cash flow as well. So this is really important. As asset managers, we are focused on improving our NOI because we know what matters. It's increasing the value of a property by lowering our expenses or increasing our income. It's what we focus on every day here at Joel Capital as we manage assets, as we manage multifamily complexes and work to bring our investors great returns and build great long-term assets.